So welcome to the third installment of the How It Works Power Webinar Series. I'm David Velasco and I will be your host today. JGS Insurance is here to help you solve your insurance issues and to help you navigate the oftentimes confusing world of community association insurance. Today, we will be covering the main coverages that constitute a solid insurance program for an association. However, every single one of these coverages could be discussed at length in an entire day. So we will just be touching on the key points to remember for maybe a brand new manager or brand new board member jumping into this arena so they can get a broad scope understanding of what's happening with the insurance program of the association. This 20-minute power webinar will be followed by a 10-minute Q&A session. To help me answer the questions that we'll be discussing, I will have Steve Roderick. He is your broker that fixes things. And Ross Rutman, your broker with a property management background. So let's jump into the keystone, the main part of that insurance program, which is the package policy. Now, Ross, can you tell us what's in the box? What's in the package policy?
Yeah, David, typically a package policy has your property and general liability policies within it.
So is that the same thing as a full insurance program?
No, absolutely not. There's tons of other coverages in the program, like your umbrella, your D&O policy, crime, workers' compensation, and there can certainly be more added to the package like terrorism and cyber.
All right, thanks. So let's jump into the first one. Steve, can you please explain to us what is the property coverage?
Sure, no problem. The property and the GL that make up the package, they're pretty much the lion's share of what makes up your insurance program. So first, the condo association property policy typically covers the building, including the roof and the siding and common shared areas such as hallways, clubhouses, gyms, etc. Sometimes they call it a master policy. The condo association's policy can also extend to the interior of the unit. Now, in these cases, the master policy may cover standard fixtures, walls, floors, and ceilings within each condo unit. Now, an association's governing docs will determine which type of coverage the association is actually required to maintain.
Okay, so you didn't mention the condos, but how does it work for an HOA or co-op?
All right, so for HOAs, the property policy typically covers only the community property, not the homes themselves. On the other end of the spectrum, for co-ops, the property policy will cover everything in the unit, excluding only personal items. Those are the so-called all-in or all-inclusive type of property policies.
No, thank you very much, Steve. Now, we're on the package policy, so why don't you tell us a little bit about the general liability, which is also referred to as the GL.
Okay, yeah, that gets thrown around a lot, your GL policy. Now, they're a bit more uniform and they provide protection should someone or something become injured or damaged on the association's property.
Well, that was a very nice definition. Thank you, Steve. Ross, can you please give us an example to which situation such coverage is needed?
Well, David, I can tell you we need these types of coverage across the board. All of our community associations require it out there. Most of the types of claims that we're actually seeing fall into property and general liability along the way. So a few examples on property would be fire, water-related claims, pipe burst, overflowing tubs, fire suppression links, you name it. That would always trigger on the property side. But then on the other hand, something that's very common for a lot of us out there are the slip and falls, and that would trigger a claim on the general liability.
All right, thank you. Another term that we hear oftentimes is the umbrella policy. Ross, can you please tell us more about it?
Yep, so just like an umbrella that we're used to take us out in the rain for protection, that umbrella policy does the same thing. It's an additional layer of coverage on top of the existing coverage and limits.
Well, can you tell us a little more about that? What do you mean by that exactly?
So all policies have limits in coverage, like the maximum that the dollars will be paid out for the claim. And the umbrella goes on top. It's in addition to your liability policy. So it goes on top of your general liability, your auto liability, employer's liability found on your workers' compensation, and your D&O, your directors and officers. It's not really the most expensive policy out there, but it could definitely be one of the most important pieces of your program.
Why would you say that? What do you think that it's so important? Steve, can you jump in?
Yeah, I can jump in on this. So imagine that you have a GL, a general liability policy, that has a $1 million limit per occurrence. That's very common. That's very standard in the industry. And a major claim is settled for $1.5 million. Without an umbrella insurance policy, the association would be liable for the extra $500,000 in excess of the policy limit. So with the umbrella, you're covered beyond your policy limit, your GL policy limit. It's more affordable use of the policy. So what you want to do is you're increasing the limits of coverage to provide an extra layer of protection.
Now, you did mention a term in your answer. I'd like to jump on that. It's the word excess. Ross, could you explain that word a little bit more?
Yeah, absolutely. I'll take that one. So the 500K in Steve's example, well, I want you guys to look at that policy had the 1 million, and then there's a 500K that was the excess, right? So it's in addition to, it's on top. That's what's covered by the umbrella, the 500K. So it's the extra protection that's keeping you out of the rain per se. So that excess insurance virtually is the umbrella. So those terms are thrown out, interchangeably. When we look at these claims, right, they deplete your limits on your primary policies on that package. And then what? Steve mentioned you're liable from the association, but I want to take that a step farther. You're liable, you have to protect those funds with the umbrella. If not, you're basically your own insurance company once you exhaust your limits.
Let's throw a little bit of a curveball to you. There's another term that is similar to excess. It's excess surplus line. Is that the same thing?
No, definitely not the same thing. I've heard it thrown out there loosely, David. So excess surplus lines is an insurance market for our higher risk associations. They insure the uninsurable per se. So maybe you're on the shore, you're in a flood zone, your property's had a lot of claims, maybe you have too many renters. There's tons of reasons why you might end up there. Coverage is a lot more costly, and sometimes it doesn't match what you're offered in the standard marketplace.
Well, thank you. Now, here's another fun acronym of the insurance world. It's DNO. What does it mean, Steve?
The directors and officers, or DNO, liability insurance, it protects the personal assets, money, etc., of the directors and officers in the event they are personally sued by employees or vendors, customers, other parties for actual or even alleged wrongful acts while managing an association.
All right, Steve. All right. In English now?
Okay. Sorry. So it protects board members while performing their duties as board members or while they're doing board things.
All right, there we go. So why is this so important? Can you please explain that to us, Ross?
So like you said, Steve, it covers the legal fees and other costs that the community may incur along the way, such as these lawsuits, right? So this is the board's policy. It protects the board. Suits come in, they create claims simply because a homeowner doesn't like the way the board is operating or doing those board things, as Steve put it. When those claims hit the loss runs, this is an affordable policy, but that low premium tends to go away for years once those claims are on there.
So true. So another part of that program, that insurance program, something to consider is the crime policy. Ross, tell us more.
So crime insurance, it's necessary for all businesses, and that includes our community associations. All in, it doesn't matter what we're talking about. It could be co-ops, it could be condos, it could be HOAs. Crime insurance covers the losses your community might experience as a result of a crime.
Wait a minute, Ross. Like, my community is nice. We don't have crime here. I'm actually offended that you would push a coverage that I actually don't need.
So, David, who knew you were so easily offended? But, well, crime, it covers a lot more than that. All right. So there's different types of crimes. Some of them go undetected, sometimes for a very long time, So when we finally catch those things, it's important to move quickly. The insurance really offers protection against theft, but it could also offer protection against fraud or impersonation, crime committed by someone hired or a volunteer. Also, again, once these things do happen, they do go undetected. And when an employee develops a habit of stealing, it's usually hard to catch it and then stop it. Small amounts over time add up to huge sums of money, so you want to protect the assets of your homeowners.
Thank you. So it takes everything in me right now to not make an impressionist example of Inspector Clouseau. But Steve, can you please give us an example of what a crime policy can protect a community association against?
Sure, I think I can do that. Ross mentioned a couple of them, but a proper commercial crime policy should cover financial losses related to employee theft, forgery, robbery, or even electronic crime. While both fidelity bonds and crime insurance do focus on employee crime, since it's the hardest to prevent, a good commercial crime policy should also cover losses related to non-employee specific crimes, such as forgery, alteration of business checks, theft, destruction, damage of money, property, or securities. Computer hacking result in transfer of funds. Sometimes, if somebody gets into your system and they're going to move some funds to an outside account, it's going to protect against some of that. Social engineering fraud, that's a big one these days. Receiving counterfeit money, that was big. And then also fraudulent electronic transfers. I think I covered that a little bit.
Yeah, well, that was like a mouthful. Why don't you have a drink of water for a second? But since we're on subject of crime, can you define this word used, this expression you use, fidelity bond?
The simple answer is actually a fidelity bond and crime insurance are basically the same thing, but a proper crime policy is much, much more comprehensive. Some people prefer to use fidelity bond because it sounds nicer.
It does. Now,
they actually are two different things. The crime policy is much more extensive.
Moving on to that next point, we're going to talk about workers' compensation. Now, tell us, Steve, what's workers' comp?
So workers' comp, it provides the medical expenses, lost wages, rehab costs to employees who are injured or become ill in the course or scope of their job. So most states require businesses with a certain number of employees, it's a very low number, to purchase workers' compensation coverage for their employees. It's protection for the employer as well. So for example, if an employee files a work comp claim, that employee is no longer able to sue the employer for reparations. So there's protection there.
Absolutely. But what if the association does not actually have employees?
I'll give you a break, Steve.
All right.
So the association may not have employees, but it's still highly recommended if not required. So there's this if any workers' comp concept out there a lot of you are used to having. So it protects the association whether you have a vendor that's uninsured or underinsured and one of their employees gets injured working on your property for the association. You certainly don't want to be held liable for that. So that's why you get that if any comp while you don't have employees.
All right. So since you have that property management background, Ross, I'm going to follow up with another question for you, a quick follow-up. If the association hires a contractor, they typically are required to request certificate of insurance from the contractors working on the property, don't they? So why do they stop?
Yep. So, but there's no guarantee, David, so like it's a piece of paper that kind of is a snapshot in time. It's a quick picture of when it was printed. There's a date along the top, right? So when there's no guarantee, for example, a roofing contractor might present their certificate. The job starts, it's a 6-month job. It starts in March, but then they fail to pay their premium, something happens, they get canceled for non-payment. We're not aware as the client, we're not aware as an employee, right? Only that contractor really knows what's going on. So now something happens, an employee gets injured. Yes, it's illegal, it happens, they don't have the coverage, they lawyer up, they find out that their job doesn't have the coverage for them. Now that lawyer seeks out anybody with a pocket, and the association is the next one on the list. So it's vital that you have this additional layer. And of course, keep checking for certificates of insurance on a regular basis.
Yeah, it does sound vital. But does it apply as well to the subcontractors that main contractor may hire?
That's an important one. Subcontractors can often be paid on a 1099 basis, and they are not covered by a contractor's work comp policy. So that's why the if any can help out there as well.
Awesome. Now we've covered the main coverages that you should have in your insurance program. We talked about the property, the general liability, the umbrella, the directors and officers coverage, the crime, the workers' comp. Is there anything else that we should consider adding as an option?
Definitely. You might want to consider adding your terrorism coverage, sometimes referred to as TRIA, which is just TRIA.
All right. So since you jumped us on this topic, why don't you explain it a little bit more?
All right, no worries. So, this would, help protect you in the event of something pertaining to terrorism, just like it sounds. So since 9/11, terrorism was no longer included in the property policies and the packages we're talking about. However, it's generally offered in addition to your package. And I want to get specific here. Like, when it comes down to it, it's not just any random act that's deemed terrorism. There's very specific federally driven conditions that are in place that define what that terrorist attack is.
All right. Can you give us some example of that? Maybe Steve, why don't you jump in?
Well, okay. Well, first thing that comes to mind for most is cities and urban areas as potential terrorist targets. But there's some other things to consider as well. Water supplies, power grids, dams and bridges, even agricultural sites can all be potential targets for acts of terrorism. Just because you can't see the New York City skyline doesn't mean that we are immune to potential terror acts. And those are defined by the government.
Absolutely. Another association may very well be adjacent to one of those targets. So that's something important to keep in mind. Another coverage that we can think about, we hear about it often in the news, it's cybercrime coverage, cyber coverage. Steve, can you tell us more about that type of coverage?
Sure. The standard commercial policies are written to insure against injury or physical loss, and they're going to do very, very little, if anything, to shield you from electronic damages and the associated costs they may incur. On a side note, I read an article about 2 hours ago about a very large company who just had to pay $40 million on a ransomware case that it happened last week. It's big stuff.
Yeah, we're hearing a lot of that these days.
Now, that's so true, but what about the effects on the community association?
Yeah, so David, I'll take that. It ranges from the content that we put on our websites, the information that we're storing in our association, and that could be on a board member's computer. Most of those times the claims are left by human error, right? Like maybe we didn't protect our computer with a password, or we walked away for a moment, right? Other times there's simply people out there that, have these desires to take something from us. So that leads to a data breach or the cyber extortion, the ransomware that Steve mentioned. And again, it's happening everywhere. I hate to say it's becoming the new normal, but we see it on the news at stores we shop at all the time.
Thanks. Now, what are some of the coverages that come with cybercrime policy when it comes to the association? How can the association feel confident that they need that coverage? What's the protection that it brings?
So I can tell you one thing here, right? Cyber insurance being in place. We've seen credit monitoring being offered to your residents in community associations. It's also very common that we have a lot of bank and personal information on our residents. We take checks, right, for maintenance fees or maybe events. Sometimes those are left around. They could be on a desk, or they're scanned in. They're found in documents like our financials on our computers. And again, that computer is left unattended, or if it's hacked and that data gets stolen, you add it all together, a hacker can certainly do some damage with one's identity or their money. So cybercrime's tough to catch, but again, one of these things that once you do, you got to notify your broker and carrier right away.
Well, let me ask you a quick question here. The property management companies that is potentially hired by the association does have crime policy and cyber policy, Can't the association just rely on that policy?
Nope, absolutely not. So you cannot rely on that coverage for any of your property management companies. They might not like me for saying this, and some others may, but you got to have your own policy in place. This one might not be listed as a requirement in your governing documents, but that's because when you guys were built and your governing documents were compiled, this wasn't a thing. But we're seeing management companies require associations to obtain this coverage. So review your management contracts, or maybe let us do that for you and see if there's any loopholes you need to contractually obtain to keep your management company in place.
Thank you very much. So thank you both of you for the clear answers you give us. I've been checking the webcams. Everybody's still awake, so that's great. We accomplished our goal, guys. We appreciate your clear answers. Now, are you both ready for some Q&A?
Bring it on, David.
Ross, because of your management background, I'm going to give that one to you. What is an HO4 and what does it cover? I really like that question.
All right. Well, just in simple layman's terms here, it covers the liability and personal property of your renters. Right? So it insures them up to the limits that they select, and it's ideal for someone renting within one of our associations. Owners should be requiring this policy out of their tenants.
All right, terrific. Simple enough. Now, that's not a question we received, but since we're on the topic, what's an HO6? And what does it cover?
So that's, specific to homeowners insurance for co-ops and condominiums. It gives them their personal property coverage and liability, as well as any betterments and improvements that they might have had within their unit. It covers strictly within the unit of these condominiums.
All right, thank you very much. Now, Steve, are these policies mandatory?
No, but associations should really require these policies with the communities to fill in the items not protected by the association's primary policy. The association's insurance is always going to be primary. Now, there's going to be some holes and some personal items and whatnot from unit owners, and they're going to be pretty upset when the stuff isn't covered. So it should be done through insurance resolutions for both HO4 for renters or HO6 for the unit owners. It helps out a lot, and then you can actually piggyback other improvements to your entire program, such as deductible resolutions to go back onto an HO6, things like that. There's a lot of things that we can do to help protect the association and help to reduce your overall costs of your programs and improve them.
All right. So here's a little bit of a tricky question because we don't have the details of that specific property in the examples that is being used or the actual details of the policy. So full disclaimer here, but how does an insurance handle water damage caused by a unit/property owner that affects other units and property owners or the common area as well?
So I'll take a stab at that one, David, and Steve, feel free to chime in. But when I first got into the industry, most of the homeowners, when something happened, a claim, they would call over to their carrier, right? And those claims were being paid out. Somewhere along the way, they caught on that they were bleeding money out the back door and that they were paying claims on condominiums, right? So then they caught on, they started asking for the governing documents, the master policy. So when it comes down to it, the condo is the primary insurance for the entire property, right? The association covers that. So water-related claim happens, it trickles through, manager gets a phone call, that individual should contact their broker, start the claim process. The homeowners and or renters should do the same thing, right? In case they have betterments and improvements or their belongings were damaged. So it's big, and it was a tough pill to swallow because so many people were very used to HO6 carriers just paying off the claims. But over the last several years, it's the primary policy, it's the association's policy that have been paying those claims off.
Thank you very much. You mentioned something about the claims that can affect, one term that we're asked to define here is renewal. Steve, can you define that? And also, while we're at it, can you tell us what's a reasonable time frame for considering renewal?
Okay, there's two questions in there, and claims can have an impact on your renewal. I think everybody that's watching this right now will agree with that. That has a direct impact. It's not indirect. Your claim history, your loss history looks a lot like a credit score or credit history. So now, as far as renewal is concerned, most policies are written for 1 year with some exceptions. And the entire program should be reviewed before it's time to renew it. We may want to make adjustments, or we may want to change carriers completely. So this process really goes on behind the scenes all year long, and the discussions about our direction and where we want to go for the next renewal should really start about 120 to 180 days prior to the expiration date to avoid the last minute rush. 30 days is not nearly enough time to present an association of any size in the best possible light. So the underwriters have a clear picture of who you guys are as an association. So there's a lot of stuff that goes on before we're ready to even talk about your renewal. So we want to start that process as early as possible.
All right, thank you, Steve. Here's another question that could be a little bit of follow-up, Ken, to my email as well, so you guys can see it, Steve and Ross. Are insurance company offering incentives/discounts for taking proactive measures to mitigate potential risk when it comes to water damages?
So I don't know that I would call it a discount straight up, right? So if we're being proactive, we're doing resolutions, we're getting burst resistant hoses in place to avoid water related claims, for example, we're doing our dryer vent certifications, we're checking everything off, every box is checked off. Now, when we go out during that 180 day renewal time, we're presenting you in a different light to the insurance carriers. And that's really where it comes down to, creating competition on the carrier side and then getting that better price. But of course, if you joined us last time where we talked about what goes on inside of our bubble, there's also a lot that goes on outside of our bubble. So it's tough to really answer, will it give you a discount? Not necessarily, but it will make things easier for your upcoming renewal.
Absolutely. Thank you for the clear answer. No more definition here. Ross, since you have the mic, why don't you keep going? What is a COI? What does it mean?
Certificate of Insurance. To take that a step farther, it's proof of insurance valid for the day it was processed. That snapshot that I touched on earlier. It doesn't guarantee that it's still valid, and it doesn't even show that there's still funds available, even if it is valid. You don't know if they've exhausted all of their package premium limits, as well as using maybe their umbrella on top. So associations should be carrying these on file for them, at least annually for each vendor. And if somebody's coming on site multiple times, I would request a certificate multiple times. It doesn't hurt. Even if they tell you already have it on file, get a new one with a fresh date and stick it in that cabinet.
Good idea. Good suggestion there, Ross. Appreciate that. We can see the property manager behind the insurance broker right there.
I always try to keep that hat on.
All right. All right. Since we're on the quiz part, there's a good one here. I think you're going to love this curveball. Steve, can you define an HNOA?
Sure, no problem. HNOA, hired non-owned auto insurance. So that's just what it sounds like. It covers the liability expenses for accidents involving vehicles that your business, or in this case, the association, doesn't own, but may or may not use for work purposes.
All right. So how does it relate to a condo association?
All right. An example would be if your employee or board member drives his or her personal vehicle to drop off a deposit at the bank and causes an accident. The other driver can actually sue your business or the association for expenses related to the crash because they were doing an association-related task. So HNOA policy, which are relatively inexpensive, can help to cover those costs.
All right, thank you very much. Now, since I like to pick on you, I'm going to keep going, but this is my question. Okay. What is an EIL? Can you please define that?
It's a French term for... No, I'm kidding. EIL is Environmental Impairment Liability Policy. It covers liability and sometimes cleanup costs associated with pollution. So most community association policies specifically exclude pollutants. EIL insurance will help to fill that gap, and in most cases is relatively affordable, where hazmat cleanups can be terribly expensive.
This time I'd like to turn to our broker with a property management background and ask him, why would an association need that type of coverage?
So, David, it's not just associations. Multiple businesses out there should definitely consider having this. Community associations really do want to look at this. Again, this is one of those policies that are not in our governing documents. So over the last few years, it's becoming more common. And it's becoming more common because there's being more claims submitted out there that were excluded. So this policy became a thing, right? So an example for an association requiring this coverage would be maybe an underground oil tank being removed. It's unknown if we had any spillage underground, right? So what we do, our claims department puts those claims in so there's a record in place, even when the tank is removed before something happens, just in case one day someone alleges damages.
Thank you very much. Now, here's an easy one. I'm gonna give that one to you. I know you and I had the conversation on that very topic maybe a month and a half ago. What is earthquake coverage?
So this is coverage for property damage caused by earthquakes. Just like it sounds, very straightforward. It's included in some policies, but it's excluded on others. And additional limits and or policies can certainly be purchased along the way.
All right, so that's pretty clear earthquake coverage. I think like it says it all. However, let's say you're not in San Francisco or LA where there's an obvious risk for earthquake. Let's say you're in Vermont or in New Jersey. Why would you want to have such coverage on your policy package or on your policy program?
Well, I for one, am in New Jersey, right? And anybody else who's here from New Jersey may have felt a small quake over the last several years. It's happened a few times, right? When I was younger, I certainly didn't remember feeling them, but it's happened over the last, 8 years, 2 or 3 times along the way. So depending on your location, A, you felt these small quakes. B, every insurance question starts with what if, David. So for example, what if an earthquake happens here? We know the answer. It's possible. Damage could certainly strike. So we are seeing a lot more community associations out there along the Jersey Shore also getting earthquake policies in place.
Yeah, and I think on that, you mentioned what if. It's probably better to think, what if it happens rather than what if I had that coverage,
Right there.
You think about it afterwards when it happens, that's a problem you don't want to have.
Leave the gambling to Atlantic City. We don't want to gamble with our insurance policies.
We appreciate you coming and joining us for this installment of How It Works Power webinar series. We hope you found some answers. So thank you so much for joining us. Have a great rest of your day.